This is Agriculture Today. I'm Samantha Bennett with the K-State Radio Network. Ahead of us on this Friday's program, we begin with Dan O'Brien, K-State grain economist, for this week's grain market update. He shares what we can expect to see through the rest of 2022 and into the beginning of 2023. Also ahead, fertilizer prices may only go up from here, according to K-State Farm Management Extension Specialist Gregg Ibendahl. He joins us to discuss the various tools he has available for producers on AgManager.info and the current challenges making for unusually volatile fertilizer prices. We end with this week's agricultural weather report from K-State meteorologist Redmond. He discusses the cold temperatures we experienced earlier this week and the increase in wind speeds that we can expect to see today and through the weekend. That and more is coming up ahead on Agriculture Today. This is Agriculture Today. We are back now for our weekly grain market update. And joining us, as always, for that is Dan O'Brien. He is our K-State grain market economist. So, Dan, thanks for joining us.
Yes, thanks, Samantha.
So today we're going to start with cash and futures, but then we're going to go into kind of a wide lens look at things. But let's go ahead and start with the current.
Yeah, the closes for Thursday were basically up a bit across the major markets that we watch. There was some positive export news in the soybean market, China buying, and some others. Weather concerns continued to impact the wheat market. Corn market had a good week in terms of ethanol usage. So by the time you look at all that, the Geese 2022 corn closed at $6.84, up about 5 2/4 cents. And of course, we're watching out into next year too. Next year's contract to look at forward contract opportunities. And so Geese corn for 2023 closed at $6.25. So you've got about a $6.84 to $6.25 differential. So from the current leads these contract to the next one. So the market is planning on some recovery, some improvement in the supply-demand situation for corn in the coming year, apparently. But, of course, there's a long ways to go, over a year to get down to that. And for beans, closed up 19 cents for the lead November 22 contract at $13.91.5. Again, looking all the way out to November of 23, we had closing prices of $13.58. So, again, about 50 cents drop into the next year. Now, for hard red winter wheat futures, closed at $9.49 3/4, and actually a declining market. Again, pardon me, that was up 8 cents. But then July 23, our next harvest contract that we're looking at, $9.41 1/4. So really only a drop of about 8 cents. As we mentioned earlier, the dry conditions in the plains certainly are an issue. Dry conditions elsewhere in the world. As more information comes out, we learn about production problems, even more than the USDA had talked about it down in Argentina for wheat. Problems, more declines in the projection by the European Union grain market watching agencies with regard to what some of their crop sizes are, and they're worse than the USDA projected. So if the big issue in our markets basically is tight supply demand, we've got some news on the demand and the supply side, all of which is indicating, if anything, decent movement, if not a little bit level to tighter stocks, and is supported the prices, just as we've seen yesterday.
Yeah, that global scale, when you think about it in terms of that, where we've been struggling with production not only in the U.S., but now we're looking at even South America kind of looking with some struggles of their own. Globally, we're working with, really, you've described it as little to no room for shortfalls come the new year, right?
Yes, and we've been talking with different groups here of late about the perspective that they could have for markets going forward. So we kind of put together about 6-7 points that kind of summarize at least our thoughts out of KSU, or my thoughts. First of all, is that we certainly are recognizing the crop production damage in the western U.S. and the Western Corn Belt, and have been most egregious in the western Kansas, Oklahoma, Texas, Nebraska area. The corn basis, last time we checked, in the last year or so, still trending sideways to stronger yet. So we're here with what harvest we have coming in. We're not seeing the basis falling off in any major way. We still have questions, Samantha, about what future USDA reports will show in terms of the size of the U.S. corn crop, that if we end up with something less than the 13.9 billion that the September report indicated. I wouldn't be surprised that we go 100 million bushels lower than that. At least that's the range of estimates that seem to be in the market right now on the low side. And the tight U.S. high demand leads right into supports the overall idea that we have really, really tight global grain and oilseed stocks for 2022-23. Again, the end of this calendar year on into the next really puts the onus on the development of those South American crops. Just as you mentioned, Argentina looks pretty tight right now for moisture. Right so far, Brazil, good planting progress, no major problems yet, but still a long ways to go. Just little to no margin for global corn and wheat production as we go forward to have short crops in some of these major production and exporting nations. Just not a lot of margin for error. And if we do have problems, then we're already sitting at cash prices in Kansas for corn yesterday ranging from about, depending where you're at, from about $7.39 on the low side of these major places we're watching, up to $8.29 down southwest Kansas. So pretty strong, and really grain sorghum prices all running $7.06 on the low side, $7.54 on the high side. For spot prices, soybeans running $13.28 on the low side up to over $14.31 in the Hutchinson area, actually. And then for wheat, spot prices still all above $9, running at again, between Colby, Salina, Topeka, Garden City, Hutchinson, and Columbus, Kansas areas that we're looking at the highest bids available. They're all for wheat, as I said, above $9, the highest getting up to about $9.34 in both Salina and in Hutchinson. And really no surprise with that, given how much export focus they have there. I would also add in that when we look at those futures, at November 23 soybeans versus December 23 corn, and do a ratio of those, about 13.48 or so for soybeans, about 6.20 for corn. You end up with a soybean to corn ratio for next year of about 2.17. So that actually favors corn a little bit. Again, the corn's just a little bit higher than otherwise. You know, at meetings we've been at lately at Chip Redmond, at KSU, has been talking quite a bit about La Nina patterns. So I would defer to Chip with regard to his thoughts on where we're going. I have heard, though, that there's from him that I think that there's some sentiment among climatologists that the chances are increasing and improving of La Nina diminishing some, which would be welcome for the world crop supply-demand situation that we're in. But add in also, following on some of the good work of my good friend Gregg Ibendahl, that we've got moderate to high natural gas prices, and that at present we've been up, we've been down, some of late, but generally the moderation of natural gas prices still is leaving us with strong fertilizer prices, strong herbicide, seed prices with other supply chain issues involved. So if there's one thing that works against the soybean corn price ratio, actually giving us a whole bunch more corn, is that the costs of corn are higher and giving a headwind for corn in the other direction. So just interesting to see, I guess. We'll be watching for corn acres next year, just given just what we just talked about, prices and costs together. It seems to be limiting corn some. Maybe we're 80 to 90 million acres sideways, a little bit lower, and probably increasing soybeans, 87 to 89 million. I have heard, Samantha, a number of settings of late that we may not see soybean increases happen sharply in any 1 year. So over the next 3 to 5 years, if renewable diesel continues to come forward as we've seen it, and to help increase the demand base for soybeans, that we keep working towards a situation where soybean and corn acres are on par, if anything, and maybe if we continue to have high fertilizer prices, and in particular, do we see soybeans consistently overtake corn for acres? That'd be a real change in the United States.
That it would. And, you've mentioned all of these different contributing factors as to why that would happen potentially. But then even when we think about globally why these markets have been so volatile, what we've seen, it obviously goes beyond just the drought and things like that. It goes into even some geopolitical issues as well that we've talked about often on this show.
Well, that's right. We can see when we look at the world supply-demand numbers, tangibly you can see what a difference it makes to take 10 or 11 million metric tons out of the net exports for corn, for wheat, off the market that would otherwise be coming from grain. If you look at where we were prior to this conflict and where they're at now, we have those amounts of differential. And frankly, go back and look at the world stocks to use and the ending stocks figures, both with and without China involved. You can just see that 6, 7, 8, 9 million metric ton differential showing right up. So we've ended up in that conflict and have tightened up the stocks in the world, and that's a major contributing factor to these high prices that we're seeing right now.
Absolutely. And then we haven't even talked about hard red winter wheat outlooks yet, but what have those really shown for what you've seen going through the rest of the year and then into the new year?
I was talking at a crop insurance meeting here last day or so, and there were nobody in the room balked at the idea of wheat seedings, although we're dry, people still coming in and seeding wheat. What they did say is that they're very likely to see people wait to the very last minute till the end planting date, end seeding date for crop insurance coverage, just to try to get moisture there to try to ensure that they actually get a stand. But all that said, the revenue insurance tools have come out that have a projection for a planting price for hard red winter wheat in Kansas of $8.79. That was the average for mid-August through mid-September closes for that July 23 hard red winter wheat futures contract. And, if we scale that down from the 75% APH coverage to scale it down, basically taking the revenue that you get from that, spread it out over 100% of your APH, you have kind of a net price of around $6.50 to $6.60, and that's not per bushel, and that's not far from where our break-even figures are. I guess now, with all this inflation, we say without much consternation that, we have $5.50 to $6.25 break-even costs per wheat, and those levels would have been surprising 1 or 2 years ago. But with all this inflation and cost that we have, now we say that it was just nobody's surprise.
Dan, thank you so much for this. I know we took a wide lens look today at our grain market, but thank you so much for this perspective.
Thanks, Samantha. Take care.
Absolutely. You as well. Once again, that was Dan O'Brien. He is our K-State grain economist for this week's grain market update. We'll be back with more ahead on Agriculture Today. This is Agriculture Today. We are in studio now with Gregg Ibendahl. He is a farm management extension specialist here at K-State. And today our conversation is really going to center around fertilizer prices and kind of what we can expect in the year to come. So, Gregg, thanks for joining us today.
Yeah, thanks for being here.
Absolutely. So, like I mentioned, fertilizer, that's the name of the game today. And really, obviously, this past year was fairly expensive. So let's kind of talk about what we really saw.
Yeah, it's been kind of a crazy year in the whole fertilizer market here. So, prices have really jumped up and down. I guess about over a year ago, maybe like the summer of 2021, anhydrous was about $500 a ton. That was, typically, fertilizers don't move a whole lot during the course of the year. Well, during the second half of 2021, fertilizers really started jumping up. They went from about $500 a ton for anhydrous, and they got up to about $1,000 by the end of the year. And then the Russian-Ukrainian war started, and they kind of jumped up even higher from that then. So about spring planting time this past spring, anhydrous was about $1,500 a ton. Now, it has since backed off, but it's still nowhere near the level it was back, about 18 months ago. So, fertilizers has become a much more important input for farmers just because it's cost so much. It's one of their most expense items on their budgets for planting grains.
Yeah, absolutely. And one of, maybe some would say, the most important item on some of their costs, in terms of planning for the season and meeting their needs.
Yeah, so I heard this conversation at our extension conference this week. There was some talk about, should we back off fertilizer because it's more expensive? And probably not a whole lot, really. Even in the scheme of things, fertilizer is kind of a cheap input for what you get out of it. So really, you might talk about backing off a little bit, but those people who are maybe thinking of backing off 30 or 40%, I would say that's not the thing to do. I think you're just going to have to, pay more for fertilizer because you do get a good bang for the buck there.
And because this past year was so expensive, you do regular updates throughout the year in terms of fertilizer prices and what you're really looking at. And you use several indexes, right, to kind of put together these models on AgManager?
Yeah, I have a model that actually I use to predict fertilizer prices. So I've been doing kind of predicting this thing for a long time, trying to do this really from the start of my career in academia. So my first model I ever developed was actually based on you looking at the natural gas price, because natural gas is the actual component that goes into the production of anhydrous ammonia. But I found out that using a model with natural gas prices didn't really work too well. I think there's a lot more volatility in the natural gas price than it is the oil price. So then I started looking around for other things to use that was going to be a good substitute. I found out oil worked pretty good. So oil and natural gas are substitutes among themselves. And then when I tried to use the oil price in my model, it worked out a lot better. So I basically, for a long time, I used a model that was based solely on the oil price and also on the corn price. And that worked really, really well until last summer when the anhydrous price started going up really, really high, so and then it kind of broke then. So then I was thinking, okay, I'm missing part of the piece of the puzzle I needed to use to predict fertilizer prices. So then I started playing around. I put in the CPI index as a measure for inflation. And when I did that, then my model started working really good again. So now my model basically consists of three parts. I have the oil price, I have the corn price, and I have some expectation of what the inflation is going to be. So that tended to cover it pretty well. So, we've seen a big jump in oil price, and the inflation has certainly jumped up to levels we haven't seen in 40 years, and the corn prices are pretty high. So those three components together contribute to the fact that, we're seeing anhydrous prices probably above $1,000 a ton going into next year.
Absolutely. That CPI that you mentioned is the Consumer Price Index, right?
Yes. For the longest time, we were at 2 or 3%, and then suddenly once we started recovering from the COVID situation, it really jumped up, and we haven't been able to get that fixed yet. So, we're still looking close to double-digit inflation here, and that's probably going to be the case for the, I'd say it's more than just a short-term thing. It's probably going to be a medium or long-term thing to get that fixed.
In terms of the Consumer Price Index, what does that really measure? You mentioned inflation. Is that really what it's a measure of?
Yeah, it's measuring how much goods and services are increasing in price, and they usually measure it over a year-over-year basis. So, the last several months, those year-over-year numbers have been about 8 or 9%. And again, there's not really, I don't really see that really backing off, because even though oil has come down this summer, the CPI index remains high. That's an indication it's just more than just an energy thing that's affecting the consumer price index right now.
Absolutely. So a big, wide overview that you're gathering here of information going into putting together these models that you share on AgManager. And in terms of what you're actually seeing currently when it comes to fertilizer prices, what are we anticipating in the year to come?
Well, looking at the fertilizer price, so again, it kind of peaked right around planting time, which for those farmers who were buying fertilizer kind of, as they needed it to plant, that was kind of a bad situation because you're probably paying the highest price of the year at that point in time. But, since then, really, the oil price has come down. So, with the Russian-Ukraine conflict going on, oil went from about $90 a barrel up to about $140 during planting time because the traders were uncertain what was going to happen to the Russian oil supply. Well, Russia's still getting their oil out there despite the fact that we have sanctions going on. So none of that 10 million barrels a day that Russia produces, I don't think is being kept off the market. Well, that oil has actually come back down in price now to it where it's actually about $85 a barrel, so it's lower than what it was before the Russian-Ukraine thing started, which is good for consumers because we've seen a decrease in the gas and oil diesel prices too. But fertilizer prices then are tied to the oil price, so fertilizer prices have come back down too. So we're a lot lower than what we were this spring when we were looking at $1,500 a ton anhydrous prices. But again, I really think this decrease in oil prices may be more of a temporary thing. So we're at $85 now. I really expect oil to go back up and maybe approach maybe $100 a barrel come springtime. Well, that's going to depend on what happens with the strength of the U.S. economy. So if we go into a recession, maybe not, but if our economy starts to recover and we avoid recession, then it's probably going to go back up to 100. If that's the case, I think we're probably looking at continued high anhydrous prices, which means, probably I would not be the least bit surprised if we saw $1,000, a ton anhydrous prices this spring again.
We've mentioned quite a few different things that have led to the increase in the fluctuation in prices here in terms of inflation, but then also the Russian and Ukraine conflict. Is there anything else that's playing a key role in it?
Well, so, OPEC has talked about, withholding and making cutbacks, but to me that's a little bit of a worry, but not near as big as the worry of what might happen with the Russian oil supply. So again, they're producing 10 million barrels a day. I don't think that's being kept off the market. What would happen if something did really happen to keep that oil off the market? I'm thinking more of infrastructure damage in Russia for some reason like that. If that would happen, then you're looking at a big jump in oil prices, which would then be a corresponding jump in the fertilizer prices that farmers pay. And, again, with fertilizer being one of the major expense categories, that's a big thing for farmers to keep an eye on.
Absolutely. And I know there's some tools available for producers when it comes to fertilizer. So maybe now's a good time to anticipate maybe using some of those tools?
Well, certainly farmers benefit from the fact that you can do cash accounting and prepay for stuff and count it as an expense this year. So, if you can have the chance to book fertilizer, again, that's going to be a little bit of a problematic because there was some issues last year with maybe not necessarily getting NP&K, but getting in the form that you wanted it. So, booking ahead and actually taking delivery could be a good thing if you're set up to do that kind of thing because, I think this could be potentially could be a low water point for prices for anhydrous and really all the fertilizer. All the fertilizer prices are very much correlated. So whenever nitrogen goes up, the P and K prices tend to go up too here. So I really think this could be a low point, and this might be a good time to buy fertilizer for this coming spring if you can do it.
In terms of everything else going on in the world of pricing and what producers should be expecting management-wise on their operations this upcoming year, is there anything else producers should be wary of?
Well, this last year has shown us that, prices can be very volatile over the course of the year. Normally when I do a crop budget, it's good for the whole year because prices really don't change a whole lot. But this last year I had to go back and revise our budgets midway through and then do a minor revision after that just because there was such a big change in prices. So really producers need to keep an eye out on all their inputs, just not fertilizer. I just did something last week where I was looking at the index of prices. So, fertilizer is up at least 30% since last August. Well, that's not the most expensive item for farmers that has gone up the most. Really, herbicides have gone up 50% since last August. So really, anything that farmers buy, practically all those major expense groups are a lot higher than the CPI index over this last year. And that's not a good thing for farmers who are thinking about putting out a crop for next spring.
Especially in sight of all the other challenges they're facing right now in terms of major drought conditions and things of that nature. It's just another thing added onto the list of trials that farmers are facing.
Yeah, they say farming is one of the most riskiest things, occupations, and certainly just from the expense side, there's a lot of risk out there and a lot of cost involved with producing a crop.
Yeah, absolutely. Just another reminder of how grateful we are for our producers out there and for the hard work that they do every single day. But Gregg, I know you've mentioned quite a few obvious resources that you put together as a farm management extension specialist here at K-State. So where can producers tuning in find some of those?
Well, if you go to AgManager.info, and you can see all the stuff that we have out there. If you search for stuff under my name, I have several of these tools out there that will help producers with this kind of stuff. So like I said, I update my fertilizer model probably 2 or 3 times a year. And if you go to AgManager.info and search for my name and fertilizer, you'll find my model that I use to actually predict fertilizer prices, which again is a function of the oil price, the corn price, and the CPI inflation index. So that's out there, and it will help producers maybe look ahead if they're looking at what I think fertilizer prices are going.
Absolutely. Anything else? Any other tools that producers might be able to use?
Well, coming up, I'm working on our crop budgets right now here, so I would expect probably by the end of October, 1st of November, I will have those out there, which will help producers as they estimate the cost of production for next year.
Well, some valuable resources for sure that I really encourage listeners to check out. But Gregg, thank you so much for your time today.
Yes, thank you.
Once again, that was Gregg Ibendahl. He's a farm management extension specialist here at K-State, speaking to fertilizer prices and some tools to help anticipate what we can expect in the year ahead. We'll be back with more ahead on Agriculture Today. This is Agriculture Today. We are ending this week's programming with our agricultural weather report, as we always do, from K-State meteorologist Chip Redmond. So, Chip, thanks for joining us.
Yep, thanks for having me.
Absolutely. So, let's start off, as we always do, with a look at what the week has held.
Well, the broken record continues. Dry, dry, dry. Actually, I don't think there was any rainfall across the state this last week. Our last widespread rain event was the 12th. That was mainly focused in northeast Kansas. So, a lot of the state just continues to dig a deeper hole where we average about a half inch, a little over half inch of rain in Manhattan area, less to the west and more to the east a week. So just a bigger deficit that way. And the temperatures, they were warmer over the weekend, but then we finally saw some cold air move in. And thanks to the dry conditions already in place, we were able to see some pretty cold temperatures. The coldest we've seen this year and the first freeze for most of the state. In fact, there was only one station last I looked that hadn't froze in South Central, but they were like 0.2 of a degree off from freezing. So widespread freeze that brought an end to the growing season across the state. And it also brought in some record cold. We saw some low temperatures in mostly eastern Kansas and northeast break records. We saw temperatures as low as the low teens, which is really cold for October. But all the records that were broken were kind of low-hanging fruit. We were right at the edge of them. So cold is back. It shows that we are taking that climatological downtrend into winter.
I understand winds weren't as high as maybe we would expect this time of year?
Yeah, something that went under the radar over the last couple of months is when we get into fall, we see an increase in winds, mainly due to strong cold fronts. and stronger pressure gradients as the pattern shifts more towards winter. We have not had that. We've had some windy days, but we've been much below average for wind across the state. And what that's done is, well, the leaves are falling straight down. They're pretty. But we're not seeing as much blowing dust, and we haven't had nearly as much wildfire occurrence as we thought or were concerned about. And mainly that helps with the dominant high pressure. We haven't had a ton of strong cold fronts like the one we had earlier this week. Well, unfortunately, that's probably going to change. As of today, the winds will be picking up out of the south. And then Saturday, they'll be picking up a little bit more out of the south. And then Sunday, a pretty substantial wind event comes across the state with 45, 50, potentially even higher gusts up to 60 miles an hour will be likely throughout the day. So we've got that wind component. We've already got drought that's holding across the whole state. And we're going to have a dry air mass in place for the most part. So fire weather concerns are going to really increase starting today through Sunday with the peak on Sunday. And then blowing dust is also going to be a big concern as well. We're going to have a lot of airborne dust. And if you don't have blowing dust locally, you're going to see it in the upper levels from out west, unfortunately. So those fire and dust concerns greatly increase along with the wind. And it looks like we're going to be dealing with wind on and off over the next week or two.
Good to know for sure. And in terms of other outlooks, any precipitation potentially on the radar?
Well, that dynamic storm system comes in on Sunday. That's going to bring a dry line through that'll help initiate a few isolated storms. And then we will have a strong cold front that'll follow it that will force more thunderstorms. But really only the far eastern part of the state has the likelihood of getting any moisture. It'll be heavy rain where it falls, probably pretty quickly. Might even be some severe weather with it. But focus for moisture is maybe up to an inch along the Missouri border with maybe some lingering showers mid-next week in that same region. The rest of the state is going to, for the most part, be dry.
Well, Chip, thank you so much for this update. We really do appreciate it. And in terms of anything else producers should be looking out for in the near future?
Yeah, so just continued dry conditions. We really need some moisture to help get that wheat out of the ground. I'm worried about wind, too, just because we're going to probably knock down some crops that have been weak, especially corn. So hopefully we can mitigate those concerns. And when we're out harvesting this weekend, just be aware of ignition sources. Make sure your equipment's been maintained and not causing any sparks, and we don't have any large wildfires, because a lot of the crop that has been harvested will and can burn, and it will burn hot and be hard to control. So let's get those crops harvested so they're not out there to burn, and let's be safe and effective at the same time.
Absolutely. Good safety reminders for sure. But Chip, as always, thank you so much for your time.
Yep, thanks for having me.
Absolutely. Once again, that was Chip Redmond. He is our K-State meteorologist providing this week's agricultural weather report. That concludes today's programming. We'll be back with more next week on Agriculture Today.